All right, I see people filling in now. I'm sure everyone will continue to join over the first minute or so, but we will be timely here and get started. So, good afternoon, everyone, and welcome to our Q2 2025 Financial Markets and Portfolio Update webinar. Thank you for joining us today. We're glad to have you here with us. Our advisors have been working hard, closely monitoring the markets, and we're always here if you guys need any advice or have any questions following today's call. So, leading today's discussion is our Chief Investment Officer, Steve Galley. Steve brings lots of experience in the investment world and consistently delivers these thoughtful, detailed insights into the markets and how we're positioning portfolios. So, there's a lot to cover as per usual. And with that, I'll hand it over to Steve to get us started.
Thank you, as always, Katie, and thanks everyone for joining. Again, we always try and make these as informative and entertaining as possible. And if you do have any feedback on how we can be better, we'd love to hear it. So lots to cover today. So let's jump right in it. We do have kind of a hot topic. We're going to spend some time on retirement planning and some interesting statistics and things to think about for those of you who are thinking about retirement or are in retirement. So I think that'll be interesting. Then, of course, we're going to talk about what's going on in the markets, and then we'll talk about what that means for portfolio and investment strategy. And there will be some time for questions at the end. And by all means, please type in any questions that you may have, and we will do our best to address them. I will also address the questions that we received in advance of this webinar at the end. So, getting on to the hot topic of retirement planning. Retirement can be very stressful for families, individuals. And a lot of that stress comes down to the fact that sometimes what you think is going to happen in regards to retirement doesn't always play out that way. As an example, in general, people think that they're going to retire around the age of 65. The actual reality, based upon statistics, is that that actually happens usually 3 years earlier, at the age of 62. So sometimes expectations and reality differs. And why does that happen? Lots of reasons. Sometimes companies downsize and people unfortunately get laid off. Sometimes there are health issues that cause people to retire sooner than they think. It could be that your skills get outdated. It could be that fortunately you can afford to retire early, and you do. So there's many reasons why actual retirement age has been trending lower than the expected age that most people think they're going to retire at 65. And so then that gets a lot of retirement planning revolves around life expectancy, meaning how long am I going to be in retirement and how long do my retirement funds need to last? So I think this is a pretty interesting chart, and I'll use my pointer throughout, and hopefully I don't scribble too much. But if, for example, we look at women, and the longer bar that has both colors represents non-smokers in excellent health versus the total population average. If you are, tells women what your percentage chances of living to certain ages are. So if you are a non-smoker in excellent health and you're 65 as of today, you have a 73% chance of living to age 85 and over a 50% chance of living past or close to the age of 90. You also have almost a 30% chance of living to 95. So, and we also have the same statistics for men as well as couples. So I think for a lot of people, they are surprised to see that actually, if you reach the age of 65, that means that your life expectancy is a lot longer than the typical life expectancy when you are born. So that's something really important for people to keep in mind, because I think sometimes people underestimate how long they may actually live. Moving on to retirement savings, and apologize for these scribbles because I had just messed up my pointer here. But what this chart shows is what does if your income in your household is anywhere from, let's say, 100 to $300,000, this actually shows what your savings should probably be given a certain age. So, for example, if you are a 40-year-old with a household income of $100,000, you should have a savings stored away in the amount of about $200,000. If you're 60 with a $300,000 income, by now you should have a little more than $2 million in savings. Now, this is assuming that you have an annual gross savings rate of around 10% and that you have a retirement portfolio that's approximately 60% in equity, 40% in fixed income. So there's some assumptions going on here. This is also assuming a retirement age of 65, but I do think it is sort of a little gut check for a lot of people to have an idea of, well, where should my savings be given where I'm at today? Digging further into it, what if you don't have any savings and you need to start right away? Well, if you don't have any savings and you need to start today, and actually, let me try and clear out some of these pencil marks here if I can. I don't know why they're on here. Katie, are you able to see those scribbles? Is that my fault?
Yes, I can see them.
Hmm.
There must be a clear or like an undo.
Let's see if I can figure that out right now.
No pressure, but
Oh, eraser. Great.
uh yep,
Okay,
looks good.
sorry everyone. Okay, so let's get back into it. So this actually says that if you needed to start saving today, if God forbid you don't have any savings yet, given a current age and given a certain income, how much you would have to save as a percentage of your income. So for example, if you are a 40-year-old and you are making $100,000 a year and you don't have any savings yet, you should start saving 22% of your income to get back on track. 22% of that annual income every year to get back on track. Very important for those of you who have not started saving yet. The other thing that comes up is, well, what am I going to spend in retirement? And so this chart looks at, on average, households that have 1 to 3 million in investable wealth. And this kind of shows, and this is real data, and thanks to our friends at JP Morgan, this is real data on spending patterns. And what you can see is as you get older, the amount you spend actually decreases, with the exception of certain categories, namely healthcare and gifts to charity. That amount actually increases as you get older, but most other categories decrease. And why is that? Well, in most cases, it's because in retirement, you have what's known as your go-go years when you first retire and you want to run around and do a lot of fun things and travel and have a lot of parties. But then you get into what's known as the slow-go years, where you're perhaps not traveling as much because it's a little too taxing. You tend to maybe not spend as much going out. And then you get into what's known as the no-go years, which is you're really not doing that much at all because you've reached the point where you mostly either stay at home or perhaps you're in assisted living. So this actually gets into the reality of the way spending changes, which is why it's really important, I think, to work with an advisor to make sure that these numbers are pretty well documented. And as they change, so does your ultimate plan. So I think these are pretty interesting to look at. And now we're going to talk about Social Security because how can you talk about retirement if you don't talk about Social Security? And I think it's really important for people to understand the trade-offs. And again, Social Security can be a complicated topic depending on when you claim, what you think your life expectancy is, whether you claim at full retirement age, before that, after that. So, for example, in this chart, what we're seeing that, and by the way, if you were born in 1954 or earlier, the full retirement age is 66, according to Social Security, where you would receive 100% of your benefits. But if you were born in 1960 or later, like myself, before retirement age, according to Social Security, doesn't trigger until age 67. So what this basically shows is what type of benefit increase or decrease you would experience based upon when you start taking Social Security. So for example, if you are eligible, if you were born in let's say 1950 and you started taking Social Security at age 62, when you first were eligible to take it, it would basically mean that you get, on average, only 75% of the total benefits that you were eligible for under Social Security because you took it early, on average. If you waited and took it at the latest point you could, which is age 70, you would actually get 132% of your total possible Social Security benefits, 100% being the baseline if you retire at full retirement age. So I think that's kind of interesting to know the trade-offs because in general, a lot of times what we counsel to clients is that if you don't need to take Social Security, don't, because your benefits will ultimately increase in total over your lifetime. Now, there's obviously lots of mitigating circumstances. If for some reason you have reason to believe that your life expectancy won't perhaps be average, maybe you have health concerns or family medical histories that you're aware of. All these things can play into these decisions. But I do think it's important to understand what the trade-offs are when you do decide to ultimately claim Social Security. And a lot of people ask, well, what's my break even? And so this is kind of interesting because it actually shows, assuming that full retirement age in this chart is 67, this kind of shows that if you started taking Social Security early at age 62 versus if you took it at full retirement age versus if you waited until age 70. So if you started taking later at age 70, it means that your break even would happen at the age of 81, meaning if you got to age 81, you would actually end up winning in terms of the Social Security benefits that you claim. If you claimed at full retirement age, you would have to reach the age of 77 before you broke even versus if you took it right away at age 62. Put another way, this kind of chart is kind of interesting because it kind of shows the sweet spot of when you should claim. So for example, if you think that you have an excellent chance of living to age 85 and you think that your portfolio is going to return about 5% on average every year, that means that you should wait to claim as late as possible or age 70. So these are all the types of conversations that hopefully you already are having with your advisor or should be having with your advisor because, these decisions really matter and it can impact, the strategy of what you may be doing in retirement and how you should be saving and how your portfolio should be designed. Now let's talk about shifting gears, what's going on in the markets, because certainly a lot has been going on this year. It has been a bit of a roller coaster. And you don't have to look very far to look at the headlines and see it's all about tariffs and trade and what may happen, what may not happen. Very hard to keep a track of that on a daily basis because it seems like it's changing every day. And of course, if we know one thing, we know the market generally doesn't like uncertainty, and that has caused a lot of volatility. This is a recent article in Barron's. Stocks are up, but tariffs haven't inflicted much pain. Why that isn't going to last. Then there was recently a lot of progress, supposedly, in our dialogue with China, where the administration most recently just rolled back a lot of those punitive tariffs that they had threatened to put on all of Chinese imports. So this is, of course, causing the markets to gyrate a lot. So when we look at what's been going on year to date, and I've sorted this by returns for various sectors of the market year to date, well, international has been leading the way by a long shot. Now, this was as of May 9th, a few days ago. But basically, it shows that US markets are flat or slightly down year to date, whereas international markets are actually up, both international developed or emerging markets. And bonds have been doing their job, kind of churning out that low but consistent return on a year to date basis. So, this actually, if anything else, tells us that diversification is important. We've always said that it's important to have some exposure to equities outside of the US. And if we had been doing that this year, that's paid off because international equities certainly have been a nice counterbalance to what's been going on in the US. By the way, a lot of that also has to do with the fact that the US dollar has come under some pressure as of late. And there's a lot of discussions about whether perhaps we are now in a cyclical dollar downturn in the long term, which, by the way, weaker dollar against other currencies benefits international stocks. So, when we talk about what's been going on with the economy, and that's important when we talk about what may or may happen in the markets, the narrative going into last year to 2024 was ironically 2024, meaning a lot of economists were saying, hey, we're going to probably have about a 2% growth rate in our economy. We're going to have a 0% chance of a recession. We're going to have around a 2% rate of inflation, and unemployment will probably stand around 4%, hence the 2024. It kind of played out that way. We did have growth a little bit above that in the US. We didn't have a recession. Inflation was actually a bit higher than that, more like 2.5 to 3%. And unemployment was pretty much around 4%, more like 4.5. So it did play out that way. But the real question is it going to play out that way in 2025? Probably not, because in the first quarter of 2025, we actually had negative GDP growth in this country. We are seeing some weakness in the employment figures, which means that that number may creep up. And of course, we still seem to have persistent inflation, which now actually may get worse if a lot of what's happening in the tariff and trade talks come through. And we'll talk more about that in a minute. But if you didn't realize how volatile April was and you slept through April, well, if you woke up in early May, you would have said nothing really happened, because despite the fact that we saw the S&P 500 index go down by almost 20% in early April, by the end of April, it had actually climbed almost all the way back. Now, the real question is, does that mean we don't have to worry about all this tariff and trade stuff? Is that all behind us? I don't think so. And by the way, some people think that what we've seen is what's known as a bear market rally, meaning the big run-up we had in the market in the last few weeks is really just a bear market rally, meaning the long-term trend this year may be on the negative side. And so, don't fall for it. Don't get faked out by what may be a false positive by stocks coming all the way back through early May. So let's talk a little bit more about whether that's a realistic viewpoint. So first of all, it's important to note that volatility actually is what generally happens in the equity market, right? The red dots on this slide show the intra-year decline of the S&P 500 every year going back to 1980. So and the gray bars actually show us what the S&P's ultimate return in any given year was. So despite the fact that the markets gyrate wildly, which is shown by the bars and the red dots, in general, since 1980, so the last 45 years, markets were positive in 34 of those 45 years. And despite the fact that on average, market drops intra-year were over 14%, meaning on any given year in the last 45 years, markets tend to drop on average at least 14%. They still usually end up positive despite that volatility. So it's not abnormal to see this kind of volatility, right? But what's really important, and hopefully we have been stressing this to our clients for a long time, is that If you try and time the market, that can be very problematic. It's more time in the market, not timing the market. And I think this slide is pretty powerful because it kind of shows that if you miss some of the best trading days in any given year, you really eat into your returns. So the analogy is kind of like your portfolio is kind of like a bar of soap. You know, the more you touch it, the smaller it gets. So it's very important to remain invested and not try and time it. And a good example actually occurred only a few weeks ago when the S&P actually had a one-day return move of 9.5%. That actually happened on April 9th of this year. I mean, imagine if you missed that one-day movement. You just missed almost a 10% return on that one day. And that is why it's very important to remain invested, stick to your strategy. So let's talk about market valuation. So this is actually a valuation slide, almost exactly a year ago, which showed that the markets a year ago were pretty expensive back in May of 2024. You know, the S&P was trading on a forward multiple basis of about 20 times earnings. And if we shoot to today, it's actually trading right around the same spot. So the markets today are still just as expensive as they were a year ago. Does that mean that we should be cautious? Well, perhaps. And we have been cautious ever since about 2 quarters ago. That's because we are skeptical that the markets can maintain the type of momentum that we saw in both 23 and 24. So let's dig into that a little bit. A lot of the administration talk is that, oh, tariffs won't really cause inflation. That's not going to be an issue. But when you look at when you actually do surveys of companies and the leaders of those companies, an overwhelming percentage of them actually say that, you know what? We're actually going to raise our prices and pass that on to our consumers to offset what may happen and what may already be happening with a lot of these higher tariffs. So it's kind of hard to justify that tariffs won't be inflationary if most companies are saying, oh yeah, we're going to actually end up passing those higher costs on to our consumers or our customers. And as a matter of fact, I think just today I saw on Bloomberg an announcement coming through that Walmart just communicated to the world at large that they will be raising their prices across the board on almost all the things that they sell. And if one of the biggest retailers in the world is doing that, you can imagine that a lot of other retailers are doing the same thing. So I do think that that raises the risk of inflation still being a problem. And if inflation is still a problem, that means that the Federal Reserve is going to have a hard time cutting short-term rates, even though our president is yelling at them to do that on a regular basis. There's also a lot of talk about how, everything looks great. The data seems really good, but there's a difference between what I would call the hard data and the soft data. And what I mean by that is soft data is this type of data you can get in advance of it showing up in the hard data. So here's an example of what percentage of consumers who have credit cards are only paying the minimum payment when they get their statement every month. And this actually shows that on average, consumers, at least over 11% of them, are now only making the minimum payment, which is the highest percentage we've seen in, since 2012 and beyond. That to me is a troubling sign. That means the consumer is getting stretched. That's an example of sometimes the soft data giving us a warning sign before it actually shows up in the hard data that the market perhaps pays more attention to. Other warning signs are emerging in the employment numbers. And we always talk about how important employment is because in general, if people are gainfully employed, if they're making a good salary, they tend to spend it, and that drives the economy. If they're not employed, or they're not finding the jobs they want, or they're not getting paid, what they think they should be getting paid, they tend to pull back. And so, we utilize a lot of research services here. One of our favorites is BCA Research, And essentially, this chart captures the extent to which the events of the past several months have really shaken a lot of confidence in employment. And like the quote we pulled out here to highlight is that following some very tentative improvement after the Trump election, the soft data on the labor market has soured significantly. Again, perhaps giving us more reason for caution. So then what do you do? Knowing that maybe caution is in order, markets are volatile. Well, you try and look for pockets where things are a little more reasonable. So we've always talked about how it's important to look at a good balance between value-oriented stocks versus growth-oriented stocks. And what do we mean by that? Well, for example, let's look at two different financial services companies like Bank of America and MasterCard. Bank of America is a value stock. It actually pays, over a 2% annual dividend rate, but it doesn't grow that fast, right? You buy Bank of America more for its stability. It's a little more predictable in terms of its cash flows. MasterCard, on the other hand, is a growth stock. It pays a dividend, but the dividend is only about 0.5%. MasterCard is constantly reinvesting into their payments platform. They are always trying to get a bigger and bigger piece of market share in terms of payment transactions and investing in new technology. That's more of a growth type of stock, right? You need a balance between those two. But what we have noticed and what this chart is showing is that value stocks still remain much more reasonably priced than growth stocks. Growth stocks have been on a great tear the last few years, but they are the ones that actually got punished the most when we saw that big April sell-off, which is why we wanted to lean a little more into the value side, again, just because it's more reasonably priced. We make the same argument for international equities. And, for those of you who ever go to a pharmacy, I'll use the CVS analogy. It's not CVS pharmacy, but CVS meaning why international stocks? Well, the C for currency, V for valuation, and S for sentiment. So currency-wise, we talked about how the US dollar has been showing some weakness. And if we are entering into a period where the dollar is going to decline against major other currencies, and by the way, the dollar has been very, very strong against other currencies for the last, at least decade plus. These things go in cycles, but a weaker dollar on average will benefit international. This chart on the left is showing how much more reasonably priced international stocks are on a valuation basis versus their US counterparts. So on a valuation side, international is more compelling. And then from a sentiment side, they're also more compelling because international stocks aren't suffering a lot of the uncertainty and issues that are happening right now in this country. As a matter of fact, there are a lot of reforms happening in, for example, a large economy like Japan, where it used to be very opaque in terms of their accounting, but now that's becoming much more transparent. They're acting much more fiscally responsible in terms of corporate governance, and those are good signs for international investors. So again, that's one of the reasons why we think it's always important to be diversified and to look to areas that are more reasonably priced versus things that are more expensive. So what does that mean we're paying close attention to in this quarter and beyond? Well, first of all, there's always a yin and yang, right? The bulls always have their points and the bears have their points. The bullish sentiment right now is, hey, this whole tariff thing, it was just a big head fake. We just did that to bring countries to the table to negotiate good deals, and overall, that's going to work out just fine. And the U.S. is still going to be the greatest place to ever to invest in. No worries. Bulls are saying that actually current earnings have been great, and to be honest, in the first quarter, earnings were really, really good. And as we always say, the market cares most about what companies are producing in terms of profits and margins. And so the market was pretty excited about the fact that corporate earnings in the first quarter were really good. And of course, the bulls are also saying that the US consumer just seems to be able to spend forever. Like the US consumer continues to drive the economy, which by the way, we know our economy is driven by two-thirds of it is driven by consumer spending, and the consumer seems to have this unlimited bottomless wallet to keep driving growth. Now, the bears will say that actually the US consumer is getting weaker and that's about to run out of steam. They would say actually that a lot of those corporate earnings in the first quarter were kind of everyone rushed to get things done before these potential punitive tariffs and trade issues got in the way. Um, and they would also say that some inevitable damage has been done in terms of our reputation, in terms of some of the friction that occurred when tariff uncertainty was running rampant, and that damage has yet to play through. So there's definitely reason to say the Bulls have some good points, and of course the Bears have some good points. I personally perhaps lean a little bit more bearish, but then again, we want to always be good stewards of your hard-earned capital, and therefore we always feel like some conservatism is warranted. So, what does that mean we're doing with portfolios in the second quarter? Remember, for those of you who have been following these webinars for a while now, we did decide to be more conservative last quarter, and I think that actually paid off. So to some extent, in this quarter, it's steady as she goes. We are pretty comfortable with the way we are allocated. We're not going to be changing too much. We may do some slight adjustments, moving a bit out of more small cap and mid cap stocks, only because if we do have a recession this year, and by the way, the new economist prediction for recession this year, depending on who you read, is anywhere between 5 and 50%. Again, because if we do have a recession, a lot of people think it would be an event-driven recession, event meaning a tariff or a trade-induced recession, which means that if you're a smaller company and you do have a recession, you tend to get hit a lot harder than larger companies, meaning larger companies can survive things like that a lot better. We also, as mentioned, we do think we should have healthy international equity exposure for the reasons that we were talking about. And bonds are still doing their job. And we said that before, and we said that it was important to have good fixed income exposure depending on which risk tolerance you have. And they've been doing exactly what they should do. Despite a lot of equity volatility, bonds have been holding their own. Now, I will caveat that by saying that the muni market got hit a little bit because there have been some threats to take away the tax exempt status of some sectors in the muni market. By and large, we don't invest in those sectors. So in general, it was sort of the baby got thrown out with the bathwater in the muni market. Overall, muni bonds had a little bit of a hiccup because of that uncertainty around some tax exemption status. I actually think that is not a concern at all. And I do think the muni market is actually now even more compellingly valued in general. But in general, bonds have been doing their job. And so we're keeping our neutral exposure to bonds. So with that, hopefully that was a quick, fun 30 minutes. On to questions. Now, I will rattle off some that we got in advance, and thank you all for asking them in advance. So one of the first ones we got was, is it better to take your required minimum distribution, meaning if you do have a retirement account, once you reach a certain age, the IRS requires you to take some out, which is known as the required minimum distribution, or RMD. And the question was, is it better to take your RMD when the markets are up or down? And I guess my answer to that is, well, it depends on how the retirement account is being managed. So, for example, if your retirement account is really aggressive and the markets have had a great run and we think the markets are expensive, then sure, that's a great time to take some off the table, take your RMD and reduce your equity exposure a bit. If, on the other hand, your account is being managed conservatively and you have a healthy percentage, let's say in short-term bonds, well, then it doesn't really matter because we can all, you can always take the RMD from that part of your portfolio. So I think the answer to that is it really depends. But in general, I always say that if you are going to make a withdrawal or a sale, it's always good to sell into strength, right? You don't want to sell into weakness. It always feels better selling into strength when you do have to make a withdrawal. Another question we got is, as you are close to retirement, and by the way, I'm glad we got all these retirement questions since we had a little bit of a retirement highlight in this presentation. As you are close to retirement, what is a conservative percentage of stocks versus bonds in a 401k? I will hedge that answer by saying a lot of that depends on your personal situation. But let's just assume that your 401k for this question's is your nest egg. And so if you are close to retirement and that 401k is your nest egg that you generally want to protect and rely upon, um, I would think that a conservative allocation would be probably around 40% stocks and probably the rest in fixed income or bonds. I think that would probably be a more conservative allocation. If you really wanted to be conservative and really dampen the volatility in your exposure to the market, you could go as low as 20% equity. But that's assuming that you really need to protect that nest egg. Um, Someone asked, what are your market recommendations for the third and fourth quarters? Hopefully, I addressed that a little bit in terms of what we're thinking in terms of allocation, meaning move into areas that are a little more reasonably priced versus areas that are not. Again, it's always hard to make these predictions, but we just try and be as prudent as possible based upon what we're seeing today. And we always try and balance like, oh, do we think we're going to get the best possible return given the risk parameters that we are allowed to take for certain portfolios. And then someone really got into the detail and asked about, do you predict pharmaceutical stocks will kind of come under pressure due to the current president's, overarching mandate to lower prescription drug prices? And I will say, actually, well, that's already played out a bit in the sense that the healthcare sector has really been an unloved sector now for a while. Um, a lot of that has to do with some of the concern about governmental overreach or underreach in terms of what companies can and cannot do in terms of charging for services or products. A lot of it also has to do with the fact that earnings in the healthcare sector have been under a lot of pressure. And again, if the earnings aren't there, the market tends to punish you. So I do think that pressure on the healthcare sector will continue. I mean, United Health actually is suffering almost a bloodbath right now, and that a lot of that has to do with not only what the macro issues facing that sector, but also uh, uh, the idiosyncratic issues facing United Healthcare in terms of a CEO stepping down and a new CEO stepping in, and now they're under investigation for potentially manipulating Medicaid or Medicare payments. So lot of litigation overhanging sometimes in that sector, which is why that area has been under pressure. Now, as a contrarian, you might say, hey, I'm going to start buying when everyone else is scared. And that's sometimes not a bad thing to do. And that actually is one of the most reasonably priced sectors right now versus all the other sectors because it has been so unloved for so long. So, that is something we pay attention to, but that was a good question. Katie, did we get any questions being written in?
So we did not receive anything so far. If anyone has any last minute questions, please feel free to submit them in the Q&A box if you haven't already. And thank you, Steve, for that great insight. We did get a lot of good questions beforehand. So just a last chance here. And as we wrap up, I just want to let everyone know we'll be sending this recording. So after the fact, you will receive an email. And with that, I'm not seeing any more questions, Steve.
Okay, Katie. Well, thanks. And I certainly, one of my takeaways is to get better at using my highlighter or laser pointer during these presentations, since I did a lot of scribbling there. So I apologize about that. But as always, thanks everyone for listening. Hopefully, it was informative, and we look forward to keeping you abreast of what's going on. And by all means, with any questions, please just reach out.
Yep. As you said, Steve, please reach out to us with any follow-ups, and we look forward to the next session. We will talk to you in August, I think is our next quarterly update. Great. Thank you, everyone. Have a great rest of your day.